The Fed putting rate cuts on the table for next year. The dot plot suggesting 3 cuts coming in 2024. News sending markets higher. The Dow closing at a record high. We also saw bond yields slide. And our next guest has key insights into the fallout of Fed policy on business. Joining us now is Don McCree, Citizens Vice Chair and Head of Commercial Banking. Citizens has $225 billion total assets. Don, it is good to see you. You're a perfect guy to talk to, Don. I want to get your reaction to the Fed news today. Obviously, investors like what they heard, but I want to get your response, Don. Also, just walk us through what it could mean for your business.
Yeah, it's obviously a big day for the markets and for the Fed, and they clearly have made the decision that we're at the end of this interest rate cycle. I don't know if the rate cuts next year will be 75 basis points or 100 basis points or 125. It's really going to be based on the trajectory of the economy. But I think this is nothing but good for our business in several respects. First and foremost, obviously, some clients have been struggling with a high interest rate burden, particularly if they've got any level of leverage. This is going to help take some pressure off that. Really depends on the extent of hedging. And we also think if rates get into the mid threes or so, you'll see a reignitement of both the venture business and the private equity business, which is important businesses for us.
Don, on that front, I'm curious what you're seeing in terms of demand for lending right now. And have you guys had to tighten your standards given the environment? Is this something that's going to allow you to, open up a little bit more?
I would say we've tightened a little bit, but I think the right word is the word you started with, is demand. There has not been a large demand out of our client base or out of corporate America in general. They have been worried about the economy, and they have been worried about the level of rates. So they've toned down their investment in their businesses. M&A is relatively muted. Lower rates could bring a little bit more M&A, which could drive loan growth. And we're also seeing a little bit of rotation with the lower tenure in particular back into the bond markets, which were quite quiet at the beginning of this year. So some of the assets that were on bank balance sheet were there temporarily until the public markets became more friendly from a rate standpoint.
And Don, I'm curious, any stress in your loan portfolio that you would call out that's of note? I mean, obviously, we talk a lot about office real estate on this show. Is that something you'd point out?
Yes. But I'd say if I characterized it in the following way, I think our C&I portfolio, so the corporate portfolios feel pretty good. I think people entered this rate cycle with lower expenses, lower debt, which really was a function of how they behaved as they went through the pandemic. So the C&I books, which is the vast majority of what we do, are performing very well, given the fact that rates are as high as they are. On the real estate side, we feel really good about really everything but office. And we're working through, we have a modest size office portfolio. We're restructuring that with the client base. We're getting a lot of constructive behavior around many of our clients. And I think it's just going to kind of pan out over 3 or 4 or 5 years as we get through maturities and the like. But so far so good. We're taking some modest write-offs, but it's not something that we're particularly concerned about, given where reserve levels are and where capital levels are and where liquidity levels are.
Don, taking a step back here, the tone today that we've been hearing from market participants is almost gleeful at this talk from the Fed. There seems to be a lot of optimism about a so-called soft landing, although it's not unanimous. From where you sit and putting all of those elements together that you've been talking to us about, are we going into a recession in 2024? How does that feel to you?
I don't think so. It's not my base case. Anything could happen, of course. My base case is either slower growth or a modest recession, nothing too severe. So our planning horizons basically have the economy slowing a bit, but not really a fundamental change. And if the Fed can achieve this reduction of inflation and a soft landing at the same time, and with decent employment, more power to them. I think it's fantastic.
And Don, I also want to ask you just about the regulatory backdrop. Regulations coming, higher capital requirements. How are you all, Don, thinking about that, navigating it? What's going to mean for your business and your returns?
Yeah, it's a natural reaction to what happened with the couple banks in the fall, that the regulators are going to tighten up again. We don't see anything that is unmanageable. It will hit returns a little bit. We've said that publicly. And a lot of the rules are still being debated. So, there will be slightly higher capital levels. There probably will be some more long-term debt, and there probably will be stricter liquidity requirements across the board. We've adjusted to most of that already, and we start in a pretty good place. So it'll affect our business at the margin, but we're not changing strategy material because of it.
And Don, you're an interesting person to speak to just because the kind of clients you have, Don. I mean, you're talking all kinds of clients. You got small businesses, large businesses, everything in between. I'm just interested in your insight into how healthy they look right now, John. In terms, there was obviously headwinds, inflation, supply chain. Do they look healthy, stable, strong balance sheets?
They look pretty good. I think if you're a very small business, you obviously have less flexibility. So they're managing their businesses very tightly. The larger and mid-sized companies are doing quite well, save a couple of specific sectors. And as I said, the prudence of management teams coming out of the pandemic and the way they've managed their businesses in anticipation of a possible recession has been quite conservative. So there'll be some bumps and bruises, but it's more margin pressure, maybe a little bit of interest rate pressure, but it's not large levels of defaults or companies having material problems.
Don McCree, thanks so much. Really helpful and interesting perspective from where you sit. Appreciate it.
Okay, thanks for the time. Have a great day.
You too.